want to invite our panelists to please come over here, and we're going to get going and start asking some questions. So my suggestion is, what we'll do is, we'll ask each one of our panelists to maybe introduce themselves and also tell us a little bit about their platform, and we'll start there. That makes sense. Eleonora, you want to start?
Happy to.
Thank you.
So it's a pleasure to be here. My name is Eleonora Bershadskaya. As Shimon said earlier, I am a principal at the Vistria Group, which historically has been a private equity firm focused on middle market corporate buyouts. I joined the firm about a little over a year ago now to help launch their real estate strategy and investment platform. And it's to date focused predominantly on affordable mixed income and workforce multifamily across the country. Before Vistria, I worked at TF Cornerstone on the acquisitions and development team here in New York City. I also worked for the city of New York, similarly focused on housing for a few years, and was in acquisitions in the urban investment group at Goldman Sachs, and pretty much focused on multifamily mixed income housing over the course of my career.
Fantastic experience. Yeah.
Thank you.
Chris? Because you've been with Taconic for like 18 months, right?
Yeah, 18 years, actually. So, Chris Balestra, President and CIO at Taconic Partners. Taconic's a New York City focused owner, operator, developer. We do basically everything other than hotel. Kind of the easiest way to sum that up. I think we've done 13 or 14 million square feet of commercial properties and about 6,000 residential units over our 20-plus year period. My role is all things new business, so sourcing acquisitions, capital raising, debt, et cetera.
A pleasure to work with. Just so you know, if there's any brokers in the crowd and you haven't spoken to Chris yet, speak with him.
Thanks. My name's Stuart. I lead our multifamily practice at JPMorgan Chase, based here in New York. We are a balance sheet provider of capital, also an agency provider of capital to the commercial real estate sector. And outside of Fannie and Freddie, we're probably the most active multifamily lender in the country.
Thank you, Kurt. And again, Chase is one of the most exciting lenders to work with. That's our capital services group. They're easy to work with if you have the right product. But you know what? I want to start with you, Kurt, if that's okay, and talk a little bit big picture. There's been a lot of dislocation in the lender, so to speak, market. We've seen Signature fail. We've seen First Republic Bank fail. And you made a decision to, Chase made a decision to buy First Republic. I think you should have bought Signature too, but that's a different story. And I was wondering, what's your strategy? What's the thought process, to the extent that you can talk to it, in terms of market share and doing more lending in that arena?
Sure. You had a slide up earlier that actually talked about the folks that were continuing to invest in the multifamily sector in New York. We are long-term investors, and so we fit that view of someone that believes, vehemently in the possibilities of New York. We like the macroeconomic fundamentals around multifamily housing, not just in New York, but around the country. There simply isn't enough housing. And so we're going to continue to be quite active there, and you'll see us in the market through all aspects of a real estate cycle.
Great. So the acquisition of First Republic actually helps you to do more, essentially.
Certainly.
Yeah. And you think you're going to do it only in New York City, or are you doing it beyond as well?
So we're focused exclusively on major geographies around the country for our balance sheet product, and then our agency lending platform, both Fannie and Freddie, is throughout the country.
That's awesome. Thank you. And you're not doing as much life sciences. I think Chris is the guy for that. So we're going to ask him about life sciences, and we're going to ask you, what do you see in that opportunity of office? it's a very specialized type of office building. You have to invest a lot of money sometimes, and you do have like captive audience. These are tenants that have to be in a life sciences building and laboratory buildings. Can you elaborate a little bit about that and strategy for Taconic?
Yeah, our strategy is, New York focused. If you look at New York, there's 2 million square feet of life science space. Boston has 40 million, San Francisco has 60 million, and why doesn't New York have more, right? It's because of condos and multifamily and traditional office buildings over the course of the last 20 years when these other cities were sort of sprawling a little bit. New York didn't.
Right.
There was some other highest best land use or land price at the very least. So the tables have turned a little bit. The research is happening here. New York is the #1 NIH-funded city in the country. First to Boston, second to New York now, for the first year, I believe. So the research is happening here. The space just isn't here. So these ideas come out of our research institutions and the tenants have to leave. So we had a little bit of a light bulb moment 5 or 6 years ago. A tenant came to us at an asset that we had owned since 2012 on the west side. It's now called the Hudson Research Center. Our original play there was we bought it for $300 a foot in 2012. We liked the basis. We could charge cheap rents and bring tenants that wanted, secondary type office space. But it was well built. Ceiling heights were good, not great, but big floor loads and 30,000 foot plates, which were ideal. So when the New York Stem Cell Foundation came to us and said, you're one of 2 buildings that we can do this in, that's available, I said, okay, interesting. We'd love to learn from you. And Taconic's had a history of kind of heavy infrastructure type projects. When we ran 111 8th Avenue, we had 1 million square feet of telecom. I think we had 160,000 gallons of fuel and countless generators. So the infrastructure side of it, which is just a much more robust office building at the end of the day, was something that we were familiar with. So once they got in and began operating, we started working with the city, who was trying to push the initiative as well. And we took a leap of faith and we put $500 a foot into the first space to see if we could pre-build it and lease it. And about halfway through design, a tenant came by and leased it. So we said, okay, this kind of works. And so it sort of snowballed from there. And we currently have about 1.4 million feet, about $2 billion worth of investment in various stages in New York.
That's amazing. And so you had an opportunity to take a building that was kind of performing okay at the time at $300 a foot and bring it all the way up to speed and get probably a lot higher rent.
Much higher rent.
Yeah, and you think that this could be an opportunity for other buildings to convert, or do you think that it has to be, for the most part, ground up, to convert from just a regular office building into a life sciences building?
So of our 4 projects in New York, 2 are pure conversions. 1 is a partial conversion, partial ground up, and the 4th will be all ground up. So it's a mixed bag, but your 40-story office building is not going to be life science. You need significant ceiling heights, ideally 14 to 15 feet. You need significant floor loads. The loading requirements for life science are more than traditional office. And zoning, you need zoning that also works. So there's barriers to entry, just like the residential conversion thesis of office buildings, which is difficult. Life science is not a whole lot easier.
And do you think that there's enough or deep enough tenant pool that many buildings, or how deep is the tenant pool for that? Because it might be tricky, right?
Yeah, I mean we're learning right now, but New York really has 2 sides of the market. There's the early stage pre-revenue venture-backed companies that everybody kind of hears about and thinks about of life science a lot. New York in particular, the other end of the spectrum are the research institutions who don't have space on their campuses. Unlike Cambridge, where MIT could just build a building if they want to. Right. We're out of space. It's Manhattan, generally. So those research institutions who are now getting the most funding in the country need more lab space. So they've actually been the most active commercial tenant over the last couple of years. Venture capital has slowed a little, but they're still out there. And we're really kind of missing at the moment that, that early stage company that becomes a big pharma company and wants to stay in New York. So we hope that that comes. But so far, as we've delivered space, we've had great success leasing it.
That's great, thank you. And these employees will need to live somewhere. So I'm going to Eleonora and ask her about your role, or how do you see Vistria, and what's the criteria for you guys when you look at buildings today? I know you're specifically in the affordable world, but how does it work? What do you want to see?
That's a big question.
Yeah.
So I would say we look at a handful of things. The first is affordability. So a significant, either all or a significant proportion of the units and the assets that we acquire need to be truly affordable, which for us translates into various sort of AMI levels, but fundamentally a significant discount to market. And we want that for two reasons. One, from an impact perspective, it's incredibly important to us to be helping to address the affordability and housing crisis in this country. And then second, financially, it also makes sense because what we get when we provide that level of affordability is a sticky renter base with low turnover, high occupancy, which translates into lower cost and better economics for the asset. So that's incredibly important to us. I would say we also sort of invest with a long-term perspective, and so opportunities for long-term value creation through sustainable business plans that don't rely on high leverage or cap rate compression, which folks have done well with over the last 10 years, but that obviously hasn't really sort of come to fruition in productive ways over the last few years. So we really want to sort of acquire assets that have and which we can sort of execute viable, sustainable business plans that don't rely as much on sort of financial engineering. And I guess related to that, when we look at sort of the underwriting for these assets, we care a lot about sort of overall returns, but we're in this moment particularly focused on yield. So really robust yield on cost, really robust cash on cash returns, just from a technical perspective. And I would say, I guess talking about cash on cash, like assets that don't require a lot of leverage to do well, so assets that we can acquire all cash and could still sort of perform well on a yield on cost basis, and that we can sort of lever up in the future, or assets that we can buy outright with really attractive assumable financing in this debt environment.
So basically getting a return today, getting a yield today, increasing it over the period of the investment, not waiting for a big thing to happen, but doing it long term and making an impact on the lives of tenants and improving the units in the building.
Absolutely. And I guess one other, sorry, now that
go ahead.
I'm thinking out loud, one other thing that's important to us and then to Vistria sort of as a whole, because the company's been around for 10 years, has been impact native and has really leaned into public-private partnerships, and sort of, as opposed to eschewing sort of relationships with government, really views themselves as a public-private partner with an impact strategy in every investment, and really views legislation as a lever for social and financial value creation. So on the real estate side, what that translates to for us is really assets that benefit from enabling legislation. Some of the things that are sort of stuck in New York City at this moment in time, but enabling legislation that unlocks both financial and social impact.
That's great. Yeah, I think we spoke about that a few times
Yes,
in the past, and I
absolutely.
think you're right. I mean, if there's a legislation that allows you to turn units and better the lives of tenants at the same time, make a financial impact for yourself, that's exactly what we're looking for. And we're going to get back to you on a specific assignment or a specific deal in a second.
Great.
But Kurt, can you tell us a little bit about what changed in terms of underwriting? I mean, we've seen, again, bank failures, but we also seen interest rates increases. We are talking about mortgage maturities. So how do you see that world affecting Chase? And I know, again, you have maybe you want to talk about it, you have a specific requirement for certain things, you have to fit a certain box, and when you do, it's a bingo. But how do you look at underwriting today?
It's a great question, and if you've ever heard Jamie speak, he talks about something called fortress principles, and what he means by that is thinking through how to stay in the business when others can't be in the business. And so what that translates to for us is we've thought about a normalization of interest rates for quite some time. We program for that. We think about eventualities in valuations and fundamental deterioration and stuff like that before they happen. And so what that allows us to do is be an active lender in a down cycle. And so we're programmed to be active today. We're programmed to continue to try to grow in this environment. And so when we're talking about underwriting criteria, I think the environment has changed, but our approach to the business really hasn't changed.
That's great. So basically, what I know and what our mortgage brokers here know is that when you have a clean building, predominantly free market, and especially if it's already an existing client, you usually is the easiest lender to work with, but it has to fit that box.
Right.
Right? Which
Absolutely.
is interesting. So that hasn't changed. That's good. And Chris, you guys are developing now big residential asset, I think, on 42nd Street, if I'm not mistaken. And is that going to be a mixed-use building? Mixed income, I'm sorry, not mixed use, mixed income?
It's a 75-25 under affordable New York program that is now expired. So it's about 300 units, so 75% free market, and then it has 2 levels of retail.
And you financed it with a balance sheet lender at the time? Oh, that's a construction loan?
It's a construction loan. It's actually a unique asset. The fee is owned by a union. Our partner is a pension fund for a union, and our lender is a pension fund for another union that is our lender. So yeah,
That's great.
Big union job.
That's great. That's great. And when is it going to deliver?
Next year. So the curtain wall's up, interior fit out's happening right now. And we have another 700 units under development in Inwood.
Right, that's with L&M.
Yep,
And you guys are doing it together?
That's mixed income, about 50% affordable and then 50% market rate. Unique to Inwood and some other areas, the market rate isn't that much more than the affordable.
Right.
That's a 421A job, affordable New York as well. There we got the state to issue bonds and LIHTC and brownfield tax credit. So we had to get that to work, there were a lot of goodies that had to happen that you couldn't do today.
Right. Great, thank you. And Eleonora, let's go back to the deals. All right, so you just invested, I think, in your first deal in the Bronx, at least in New York City. Want to talk a little bit about that? I think it was close to 1,300 units.
Yeah, so it was a 5-building portfolio, 4 buildings in the Bronx, 1 building in Upper Manhattan. It was compelling, I guess, for many of the reasons that we've already sort of covered, but at the risk of redundancy, it's a portfolio of assets that benefits from something called Article 11, which is a long-term tax abatement that the city, state, and a nonprofit sort of work together to grant to owners in exchange for long-term affordability. So that was, and they're about, publicly available information, there are about 30 years of tax abatement remaining on these assets. The second thing that appealed to us when we looked at this portfolio was the heavy CapEx, the heavy capital investments that have been made in this portfolio over the last 10 to 15 years by prior ownership. And this one is a portfolio of rent stabilized assets, so definitionally it's an older vintage portfolio, and that needs a little more TLC when it comes to capital investment, and a lot of that work had been done already, so it gives us a lot of confidence in sort of the stewards of the asset that we were acquiring it from. And the last and probably most important thing was the level of affordability that will persist for a long time across the portfolio, especially in places like the Bronx, which has seen pretty significant rent growth over the last 5 or so years, and also just speaking of land, there's more development opportunities there. So having sort of a haven of affordability in that geography is important to us, both, again, from an impact and financial perspective.
That's great. So in that portfolio, you did have the property tax abatement in the Article 11, and also that what creates the building as affordable, right? It's affordable
Absolutely.
housing because of that regulatory agreement. What about, do you see any opportunity to benefit tenants on the one hand and increase rents on the other in that, or is just going to stay rent stabilized?
I mean, it is rent stabilized. It's a pre-1973 portfolio, so it is subject to sort of rent caps. We'll abide by the rent caps. The last sort of RGB, which is the body that governs sort of the max rent increases, the last approved rent increase was 3% for one-year leases, a little, pretty much that for two-year leases. And so we're going to abide by that, and we will rely on the tax abatement to allow us to sort of make the kinds of investments and operate the asset in a way that allows it to be quality housing for our tenants.
All right, so efficient, and again, the yield made sense to begin with, and that's what you're looking for. So the impact is there on the one hand, and you get something in return along the way, which is great.
The other thing, again, just speaking, since we have a lender here as well, and since we talked about GSC, agency financing, so modest leverage from Freddie Mac placed by KeyBank. And to the point that you made earlier, the agency player here was really, really important because they also deploy mission-driven capital to affordable assets. So it's sort of, it really took a village to make this work in a financially compelling way. But we're excited about it.
Yeah, it sounds like it. It sounds like a great investment. And Kurt, do you do affordable lending, right? I mean,
Yep.
And I think you increased your mandate in the past year or something. Want to talk a little bit about that?
Yeah, absolutely. So we do, we have a community development bank that does development for affordable housing. We have an agency platform that through Fannie and Freddie provide long-term financing for affordable. We also do some on the balance sheet. We have an affordable preservation program where we incentivize affordability vis-a-vis interest rate incentives. And that program was launched about 2 years ago as part of the firm-wide racial equity commitment, and it's done quite well. We've been quite active in that program.
That's great. And we all know that the land market is tough now because you can't really build without a 421A, and we don't have that. And we just heard about the executive orders, so the Gowanus is going to be a little bit more active. But, Chris, are you guys looking at land today, or how do you look at developing anything today in this environment, or you just don't?
I mean, it's hard on the multifamily side. We always look for a covered land type of opportunity. So if we can clip a decent yield and see ourselves through to, another era with abatements back in place, or an alternative use that might come into the future, that's always interesting. We have, a lot of times ULURPs are necessary. There's partnerships with the city where you have to, take it through the rezoning and you don't get possession for a few years. We have one of those assets underway right now. So we're, kind of always in the market, but it's hard to just buy a piece of land today and say, I'm going to build multifamily in a year.
That's right.
You can't do it.
That's right. You have to have the vested. I mean, if it's vested, it's one thing. If it's not, it's an issue. And what you're saying is so interesting because we're hearing developers talk about land banking, like what you said, the covered land play, right? To keep it for long enough until things change and buy it, hopefully inexpensive. I don't want to say cheap. Inexpensive enough. But what other opportunities, Chris, are you guys looking at today? Is there anything in the mortgage maturity world or mortgages that you're looking at, or any other opportunities that when you talk to your team about, you're trying to source in New York City?
Yeah, I mean, historically, we're not a lender. We have done a little bit of that. We're really talking to a lot of our capital partners who are going to be the ones that are writing those big checks to either acquire the debt or to provide pref equity on certain deals, saying, we'd love to invest alongside of you, and if things don't go the way they're planned, you've got an operator, ready to go and ready to take over and do what has to be done for the asset. So we're looking at a lot of those opportunities. nothing come to fruition quite yet. On the fee simple side, there's effectively no capital for office on the lending side or the equity side. I know, I'm not sure what Chase's position is, but I know some of your competitors are just redlined office, period. So until that changes, it's going to be tough to see a lot of office trades.
Yeah, that's super interesting what you're saying about office, because if you see the numbers, it's either lenders are taking back office space or extending for the right properties and the right owners, which I think is super interesting. And Kurt, why don't we talk a little bit about that if you're comfortable? Sure. Basically, there's going to be some maturities also at Chase, although you did everything you could to underwrite really, really well. Maybe it's in the office segment, maybe it's in maybe it's in rent stabilized. How do you guys approach an extension with a borrower? How do you feel about it?
Yeah, so I mean, we're always looking at serving the client, right, first and foremost. And I would say, where we do have challenging situations, office is a sector that, as Chris mentioned, is tough to underwrite today. There's more question marks around it than there are answers. And so we're going to try and think through those thoughtfully and put the right answer forward with in lockstep with a client. But like everybody, I mean, we invest, we take some risk, and in certain situations, that risk wasn't well placed.
Right. So one of the things that was asked also before is about these extensions, and what we're seeing in the office market and in general is that a lender usually will work with the right borrowers. So it has to be the right borrower to work with. Yeah. And if there's a pay down or something along these lines, it's probably going to be extended. I'm curious where you guys see the next 12 months and opportunity for each one of you in this market, because again, it's a choppy market in a way, right? And there's a lot of things happening. But where do you see the opportunity here, specifically in New York City in all boroughs, for investing or for lending? Anybody wants to start?
I can take that. For the next 12 months, and I would say, longer than that, I mean, we see a pretty healthy opportunity to continue to invest in the space. The regional banks have pulled back significantly, transaction activities down, but we're prepared for all of those situations and looking to take on new customers and serve existing ones.
Awesome.
Yeah, I think we're kind of waiting for some of the distress to hit the street. It's really hard to go into a new development when your interest rate's 10, 11, 12%, and make that work. So I think you're going to continue to see development slow for a little while until things hopefully start coming back down. And when that happens, even when the Fed finally says we're done, if they really will say that, that hopefully will open up the banks a little bit to add some liquidity to the system. That's what we really need.
Thank you.
Yeah, right. We're focused. We're not focusing on ground up for that reason at this moment. We're focused pretty much, unless it's like a longer term opportunity, we're focused pretty much exclusively on highly occupied assets with, again, a significant sort of level of affordability on the entire or a portion of the asset. So mostly preservation and sort of improvement opportunities, both in New York and really across the country.
Questions? Thank you. And it's interesting because you're coming into this market relatively new, so you have all the cash in the world to invest. So it's a pretty good opportunity. If there are any questions, we asked a bunch of questions from the crowd and we got some questions, but if there are any questions here, we're going to try to answer them. If we can. Not everybody can, but if we can.
Question to Chris.
Yes, hi.
Would a medical building or a life science building qualify as a community facility?
It depends on if you have the right user coming in, then you can do some of it potentially as community facility. But traditional life science would not.
Shimon, can you repeat the question?
Yes, he asked if a life sciences building will qualify as a nonprofit building, as a community facility building. Or a medical building, yeah.
Would it?
It really, like, if you can build a building using the community facility zoning, but then you have to put a community facility user in there that qualifies. So it really depends. Most of those get built because there's a user who's ready to come in.
In a low-income housing area?
What do you mean?
Yes.
Question about the shelter space and sort of the extensions on the shelter space, so like the city FEPS programs. You know, I've been working a lot with different developers who've been taking advantage of that, and I'm aware of a lot of hotel trades that have happened with buildings that are at their end of their economic life where they're converted to shelter space. And there obviously is a need for more shelter beds. Is that an area that you see more investment opportunity in going forward?
That's something for you guys, Eleonora or Chris?
I mean, we're focused predominantly on like more traditional, affordable multifamily. We, on a different platform, have invested in supportive housing, which I think is closer to a shelter. And so I don't think we're precluding, you know, shelters, and I assume that you're talking about like homeless shelters, right? Like transient. We're not like precluding shelters from our scope of focus, you know, but I wouldn't say, at least on our team right now, I wouldn't say that we're laser focused on investing in them. Although I agree with you entirely, the need is tremendous, and if this city and other cities who are facing similar challenges, if they sort of come together in a way to make it like a programmatically, you know, if they sort of build a program around it that harnesses private capital in a way that makes it sort of feel like we can do it, we can invest in it and manage the risk of it while making a significant impact, I think on our side it's something that we would certainly look at. So I agree with you that the need is there. I just, on our side, we haven't necessarily been focused on it, and I haven't seen sort of a programmatic approach to it by the various city and nonprofit players around it.
Yeah, I think, Eleonora, you hit it right on the head. I think that every affordable housing developer or mission-driven capital, they're not really looking at that as a specific program. They're looking at doing what they know what to do. The FEPS has been successful, or those that are looking for it are looking, you know, looked at opportunities in, for example, vacant buildings, pre-TCO, with the ability, that wanted to get the 421A but can't, or something along these lines. And I think that Eleonora hit it on the head. If the city wants to focus on that, make it a program, make it subsidized, and provide the capital and the incentive, the financial incentive, that would be a lot more successful. Otherwise, there's enough affordable housing work to do without it, if that makes sense. Yes, Matt Swerdlow.
This question's for Kurt. Did the FDIC approach you guys to buy the Signature assets? And if they did, what was different about that versus the First Republic opportunity that you guys could pursue?
I can't talk about any specific transactions. I think we've made some public disclosures about First Republic. So I would just refer to you to our investor relations folks for that stuff.
Thank you. Someone else had a question there. I'll answer your question, Matt. I think it was just too early. I think it was just the first time, and you don't have to comment on that, but it was probably the first time that they see something like this happen and they prepared afterwards or something like that. That's my hypothesis. I might be wrong. Anybody else? Questions? I saw another hand there. No? Okay. Okay. Oh, yes.
Do you have any prognostications about what's going to happen with 429 in the years to come, how the politics will work out, who's going to come out on top, will it get tied in with tenant rights regulation?
I don't, but maybe someone here does. I mean, Eleonora, I know you worked with the city, at the city, you did a lot of work there. I don't know if you have any feeling for that. This is, I think, to me, it's all politics. Unfortunately, it's not beneficial for New York City, meaning there's no discussion about creation of housing, and that's really what we need, right? So I don't have an answer, and it's sad because we do need the creation of housing to maintain affordability in general. Doesn't matter what kind of housing, affordable, middle income, free market, we just need housing. And unfortunately, it hasn't gotten done. I mean, I think we have a governor that wants and a mayor that wants, and everybody surround them doesn't. So I don't know how it's going to be resolved, unfortunately.
Yeah, I mean, I agree with that, and I think it's hard. Obviously, I'm no Nostradamus, and none of us are, so it's hard to like forecast the future. But I do think that I think it's politics that are working really, really against the best interests of New York State and New York City. And I think that on the politics side, at the state level, which is where this is really sort of living and dying, the state legislators are just being really, really challenging, notwithstanding the governor's desire to get something done. And that, if anything has to change, it's really, really that. I think a coalition needs to be built at the state level among the legislators to get something done, and that just hasn't occurred yet. And until that happens, I think we're going to be at this impasse, unfortunately. But I couldn't agree with you more that the state, the city, the country, but the state, in the case of 421A, really, really needs to come together in a productive way to unlock this impasse and enable more housing production to address the supply crisis that the city is facing.
Thank you.
I have a question for Eleonora. Are you investing outside of New York City as well, and what markets are you investing in?
Yeah, we're looking at acquisitions across the country. So we're narrowly focused on the U.S. And the markets. So I would say the markets that we sort of have a three-pronged criteria, three-pronged sort of selection strategy when it comes to both markets and assets. The first is, markets with enabling legislation, like I said earlier. We're seeing a lot of interesting stuff in that respect in Texas. Texas has expressed a lot of interest and actually set forth pretty interesting legislation when it comes to tax incentives in exchange for long-term affordability. So Texas is a really interesting market for us. There are, parts of California are really, really challenging, but there are also examples in California of legislation that does the same thing. So we're looking, we're looking to be a public-private partner with governments that really want to enable housing production and create incentives to ensure long-term affordability. So I would say those two states right now are a big focus for us. And then other criteria are also, we do everything with operating partners. And so again, those two states and submarkets within those two states, we have a strong network of operating partners who have pretty tremendous local expertise. So we are looking outside of New York. Those two are a particular focus for us at this time, but we're going to continue to be active in New York as well.
Thank you.
I was going to ask a follow-up. You mentioned that these legislatures outside of New York City are cooperating with housing development. What types of programs do they have, and are they programs that we could use in New York?
Yeah, I mean, so the irony is that I would say like New York's arsenal of programs historically is unprecedented. Like New York, I would say, is one of the most, if not the most sophisticated affordable housing markets in the country. It's just there are political challenges that are sort of causing some of these programs to remain at a standstill. So the programs that we're seeing, again, by way of example, California and Texas, are very similar to the tax abatements that you've seen in New York, where you get sort of an abated real estate tax or a wiped out real estate tax in exchange for long-term, so in some instances 20 years, in some instances 30 years affordability at the asset level. So I mean, it would be very similar to like a 421A type of program. Unfortunately, in New York, 421A is no longer unless you're vested. So, and New York City has so many other different, like so many other kinds of programs that I think other states are borrowing from. It's just the politics have made those programs either challenging to get off the ground or just completely or just kept them at a standstill. Like again, 421A being the biggest and most well-known example.
Yeah, even asking for an Article 11 is difficult, or going into
Yes.
420C in cases that you do have the tax
Yeah.
credits. And so you're absolutely right. It's a lot harder.
It's
in
a lot
New York
harder,
City.
but again, I would say that states are using New York City as an example. I mean, there are states that are enacting, inclusionary housing, for the first time in the way that New York put it in place through MIH, through the mandatory inclusionary housing program. So I think New York, by way of the brilliant sort of policymakers that have done really great things in New York, has an arsenal of programs that other states and municipalities are borrowing from. It's just the politics of New York are challenging right now.
Yes, Michael.
I have a question that would be good for Nostradamus, but he's not here.
Alas. Maybe we can summon him.
What is the political tipping point that gets the intransigent, I think I said that right, politicians to move?
I don't know, you have to speak to them.
I think it
It's
needs to
tough.
be bad enough.
Yeah.
Vote them out.
Get them out.
Yeah, I mean,
That's a good
voting helps, Again, and I think what the irony of everything is that everyone has really good intentions. Their goals are really laudable if you can just sort of take the politics out. And so I don't know how to answer that question. I think we're all sort of struggling with it.
Yeah, we've been struggling with it since 2019, Aegis TPA.
Yeah.
You're starting to see, I don't know if Jay Martin from CHIP is here, but he will tell you that there's like tens of thousands of units that are vacant. That's not good for the city. And then you have dilapidation in buildings. You'll start seeing it, maybe not today, but in 2 or 3 or 4 years. And that's when tenants are going to suffer enough to tell their elected officials we need to do something.
So just as a follow-up on that, I think once politicians, and again, my wife always tells me don't talk about politics, but
She's smart.
The easy constituency, which were the tenants, that those laws were put into place to try and appease, I agree 100%. Once their buildings become dilapidated because the owners don't have any incentives, that's when it'll change.
Right. My wife just tell me not to talk.
But I don't listen.
Yes.
Question for Eleanor first. How do you, within affordable housing, how do you account for the risk of affordable housing tenants not paying rent?
Within affordable housing, how do you account for the risk of affordable housing tenants not paying?
Yeah, not paying. How do you account for that in underwriting or acquisition?
You want to start?
Go for it.
Well, first, from a lender's perspective, you're aligning yourself with an operator that understands the market. I think that's, first and foremost, the most important thing you can do there. And, the understanding that they have in how to operate in that environment with the tenancy, whether it's submarket or building by building specific issues they're working through. We look at all of that stuff up front. We look at cash flows up front. Cash flow is one of the most important things as a lender you can look at. And so by aligning ourselves against those principles, that's how we think about it when we step into a loan.
Agreed, and on the equity side, we do something. We approach it similarly. COVID, obviously, and the eviction moratorium gave us as buyers really good data for how the building sort of performs when the economy and tenants are either under duress or don't or it's harder to collect on rent. And so we take that data and we assume sort of a collection, a bad debt number or a collections number that is relatively consistent with that performance, and we price the asset accordingly.
I also think if you're talking about like truly affordable housing,
Yes.
those tenants are vetted extensively by the city before they're entered into the lottery, and it truly is a lottery. There's 100 units, there's probably 10,000 applications, maybe 100,000 applications. So when those people get chosen in the lottery, they're very incentivized to stay and to pay the rent.
Chris, you're talking about the 25%, for example, that you're developing on 42nd, 25% of them going to go through the lottery, and
or even a
you got it.
100% affordable building. It's the same process to go through in order for those tenants to be, given a unit.
Right. Now, go ahead.
Yeah, no, like when you you still have to demonstrate, credit work. You have to have a credit score. There is sort of a background check that's performed, et cetera. And so, if you're a buyer, you're looking at sort of a collections number that you want to be fairly healthy, and you assume that if it is, you assume that the stewards of that building before you were doing right by the tenants, but also bringing in sort of creditworthy tenants who pay their rent.
Yeah, and I think this is very insightful, and I'll add two things. I think overall, the affordable tenants are paying to begin with a lower rent that they don't want to lose. So really they want to pay. And the second thing, in some cases you have vouchered tenants or project-based Section 8 tenants, and most of these rents are paid by the government. So the very small portion of that rent is paid by the tenants. And that's, again, another incentive for the tenants to keep paying, if that makes sense.
And the one other thing too is I will say that HSA, there have, in the last year or so, the city has really stepped up to help folks who have experienced hardship and, have sort of been in arrears on their rent during and after COVID, to help sort of be a stopgap measure to help sort of make folks current. And that has been pretty tremendous in both sort of retaining those tenants while not inflicting sort of economic hardship on them and making them current and sort of assuming that they're going to go back to sort of their performance pre-COVID, pre-hardship.
Awesome. Yeah, last question, please.
I have just one question. For office building real estate properties, what do you guys foresee for the future of those kinds of buildings in upcoming years?
Chris, you want to talk about it?
Sure. I mean, I guess if I had a crystal ball, it would be nice. I think that we continue to see more people coming back to the office, which is good. I don't think that we make it back to where we were, and the tertiary and secondary type of buildings are going to suffer long term. And ultimately, they'll turn into something else. I mean, New York is pretty good at reinventing itself over and over. This is no different. I think you're betting on the fact that people want to be here, and if that's the case, so long as that continues to be the case, we'll figure it out. But might be a little ugly in the short term.
That's awesome. Thank you. All right, Eleonora, Chris, Kurt, thank you so much for spending time with us. Really appreciate it. And that concludes this part of the program. We still have food and coffee, and you can stay here and network. Please do. Thank you.